right, welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. Thank you so much for tuning in today. Welcome, Justin.
Thank you. Thanks for being here.
How's your week going? Good?
It's going good. Yeah, I actually just got back from a doctor's appointment for my little baby girl, 2 months old. She got a couple of rounds of shots and was not so happy about it.
Oh boy. Yeah, shots are never good. There's a lull after like 8 or 9 years old where they do one a year or whatever beforehand. So, but you'll be there soon. You'll understand. So
I still got a little time.
So welcome to our listeners. I think today is a good timely topic. It's going to be a little shorter session for us, but we really want to talk about handling investments in a down market.
Yeah.
We want to talk about, kind of some of the things that you can do to help your investments in a down market, and then also obviously move forward with maybe getting a better return as the market rebounds. So, So let's dive into it. It's your time.
Your money.
And I'm going to do the honors today and flip this.
All right.
So it'll be a little easier for us. So yeah, ultimately let's start with just what is out there and is blatantly obvious, right? Is the trouble that we're having in the market, a lot of issues, inflation, bond market's getting crushed right now. Stock market's all over the place.
Yeah.
Right. We're down from historic highs.
We are.
Right.
Yeah.
But when we look at that from an investment standpoint, we have to really delve into what an investor should be doing and understanding about their investments. Right.
Yeah. Yeah. Absolutely. I think one of the keys when you're looking at a down market, like we were talking about just kind of prior, is looking at doing some type of dollar cost averaging. Hopefully our viewers have heard it at some point in time, but just talking about being able to consistently and systematically add to take advantage of when the market is going down to purchase shares at a discount.
Yeah, right. The one thing I always phrase to clients or prospects is, it's the only commodity that is sold in the United States that when the price goes down, people don't buy it.
Yeah.
Right? If you went to Walmart and you wanted to just shop for random stuff at Walmart, but you saw a sign that said 30 cans of tuna fish for $1, even if you didn't need tuna fish, you're probably going to buy 30 cans, right? You'll get home, your wife will be like, "What are you doing with the tuna fish?" It was on sale, right? Right? I remember my father, he came home, he had like 10 of these little plastic chairs for kids. I only have 2 kids. I'm like, "Why'd you buy 10? Oh, they were only 10 cents each," right? But in the investment world, when investments go on sale, which is when the market goes down, ironically, it's the only commodity that people don't buy.
Yeah.
And a lot of it has to do, with psychological investing. We did a really good segment for our listeners that maybe didn't listen to it on emotional investing. But let's get that out there right away. Is that if it's a good investment, then it's worth buying when it's on sale.
Yep.
Right? Just like any commodity.
Yeah, absolutely.
Right. And the problem is that fear usually takes over. Right. But there are some little things that investors can do to get a better return in a down market and ride out those cycles. So the very first thing they have to do is understand that the market will come back at some point.
Yeah.
Right. I mean, it can't be down forever.
Yeah, absolutely.
Right. And I don't know about you, but the common thing I get is, well, it's different this time. Right. I don't know. You ever get that from a client?
I do.
Right. And I always tell clients, well, of course it's different. Right? If it was the same every time, we could adjust and avoid it.
Yeah.
Right? So every time the market goes down, it's going to be different. There's going to be different nuances to it. But what isn't different is that the top companies that are out there are still going to be in business tomorrow. Right? I mean, Walmart's not going to go out of business.
Yeah.
Right? What other companies aren't going to go out of business?
Oh, Procter & Gamble, Coca-Cola, Caterpillar, and all these large
places.
places.
Most of the S&P 500 companies are not going to go out of business overnight.
Yeah.
Right? It's not to say that they can't fail like an Enron, or they can't, have struggles, but we know they're not going to go out of business overnight.
Yeah.
And if we know that, and we know that they're going to come back in value, then we just have to make sure we have enough time to ride out that cycle.
Sure.
Right? So how do we handle it? What are maybe some things that we can do? You brought up dollar cost averaging, right? So that's new money coming in to buy at a low.
Yep.
Right? What are maybe some other things that a listener can do?
I mean, you can look at restructuring some of the investment strategies that you have.
Right. So maybe you look at your portfolio and say, hey, I've got money in cash. Maybe you've got money in the bond account, or in your checking or savings that you want to infuse in and rebalance to the stock side that's now down in your portfolio.
Yeah.
Right. And we're at a weird period of time, right, where both stocks and bonds are down.
Are both down, yeah.
Right. Traditionally, it's like a seesaw, but now, now we're running in a period of time where both are down. Right. So, for instance, maybe a client's taking a dividend.
Okay. Yep.
Right. Maybe they don't need the dividend. Well, what can they do? They can temporarily reinvest it And that's going to really help you in a down market because it's going to buy more shares,
Yep.
not new money out of pocket. Right? For people retired, they might not have new money to put in.
Yep.
But they may just postpone their dividend for 6 months. That'll help you rebound a little bit faster, right? Yeah. What are some other things that investors can do?
I mean,
think fixed accounts,
yeah.
right?
Yeah, you can do things like different types of fixed annuities, different types of if you're doing something where you're getting income, like you were saying, from like an immediate annuity or something like that, and you don't necessarily need that money. You can do something a little bit different.
Yeah, maybe redirect
CDs,
it.
maybe.
Yep, redirect it into an investment.
Yep.
Maybe you have a CD that's coming due and you don't need it.
Yep.
Right? Sometimes it may make sense to take a penalty on a CD because the penalty is very small.
Yeah.
To infuse it into an S&P fund or something that's more growth oriented.
Yeah.
Right? And it goes back to when is the real risk, right? Is the real risk now after the market's down 20% or whatever, or is the real risk a year and a half ago after COVID when the market was up, a substantial amount.
Yeah.
Right now, the real risk already passed.
Yep.
It's down low. So, not to say that the market's not going to go down more, but it is a buying opportunity.
Yeah, and the way that I like to think about it too with buying opportunities is that if you get something that's 20% off and you find out that it ends at 27% off, you're still going to be happy getting the 20% off.
Yeah.
Not necessarily buying at the lowest point in the market because it's almost impossible to time that, but you're still getting it at a discount. So you can still be happy knowing that you weren't buying at the top of the market where the best
visual example I always tell a client is imagine a clock, right?
Yep.
And if you ask somebody where are we in the market in relation to a clock, meaning 12 o'clock being an all-time high and 6 o'clock being an all-time low, you're going to get wide array of different answers. You're going to get, we're at 5, 6, or 7, right? I think most people would agree we're at the bottom side of that clock.
Yep.
Right? We might be at 5 and it might go to 6, or we may have passed 6 and it might be coming back at 7, right? But we do know we're at the bottom. Well, if we know we're there and it has to come back around, which it always does, then why not add now over the next 3 months, 6 months to a year, right?
Yeah.
And that's the kind of visual that I think most clients need to have in their head is where are we on that clock?
Yeah.
Right. And we can argue which number we're at, but we can't argue that we're at the bottom side of the clock. Right?
Yeah. We're definitely not around 11, 12, or 1.
Yeah, 11, 12, or 1, which is the main thing. Other things that investors can do, in a down market to handle, the fluctuation in their accounts, they can go more towards buffered products.
Yep.
We did talk a little bit about that. So if there still is a lot of fear out there and people don't want to get more heavily into investments per se that are not buffered, they might find a buffered investment. And we have a great podcast on that. People can listen to that episode,
Yep.
On why you may want to get into a buffered investment.
Yeah.
Because if you're uncertain, you can still partake in that market rebound, but still have more downside protection.
Yeah.
Right.
Yep.
What are some things that maybe people can do in their personal life to free up money or invest more in a down market? What are some things that we should talk to clients about?
I like to talk to clients about just budget, cash flow, where money is going, and then I also like to talk to them about like you were saying when you are withdrawing, maybe changing the vehicle or solution that you're using to withdraw that money out of. Like you were saying, don't want to necessarily draw during a down market. So there might be other avenues or other things that they're using, clients specifically, like we were talking about, that can help to ease some of that pain of the market going down.
And maybe it's filing for Social Security.
Yep.
Maybe they've been waiting since 62 and they're now 64 and a half and their full retirement age is 65 or 66. And they might want to file now and stop all distributions from their investments and kind of give it a respite.
Yep.
Give it a little relief, let it rebound, let it reinvest. Right? Investors have to understand that even if you're not putting new money in, most mutual funds or bond funds, stock funds, a lot of those funds have dividend reinvestment.
Yeah.
And even if you're not adding in, just having them sit there and earn those dividends and get a good number of shares added to them while they're down, that could be a very important part. So, let's talk maybe a little bit more about, kind of why the market goes down and some things that are coming up with inflation and stuff. But we'll do that right after our community spotlight, which is always a fun time. So, today we have Pastana Brothers Pizza. So I don't know about you, but I love pizza.
Oh man.
And Pastana Brothers Pizza is over in Troy area. They're at 52 North Greenbush Road, Troy, New York, 12180. And their phone number is 518-272-7200. Pastana Brothers Pizza. Go and get some tasty pizza.
I had pizza last night, actually.
I have it every night. It's pretty much. I have 11 and 7-year-olds, so that's the most common takeout food
Awesome.
there is. So, we spent a little bit of time talking about, kind of the down market, but let's just talk about inflation a little bit.
Yep.
I know we've done some other segments on inflation in general, and one of the things that we really want to emphasize with clients is during inflation, the cost of goods obviously is going up. Money might feel tight, right? In your portfolios, most of the time, there are options of where to take money without selling when it's low.
Yep.
Right? If you look at a portfolio on average, like at least in our portfolios and stuff, right? We have stocks, we have bonds, we have some cash positions. Usually we have fixed positions, right? So even if you're not adding, but times are a little tight for you, you may want to start some distributions from the fixed accounts.
Yep. Yeah. I think that's one of the big things that if you haven't worked with an advisor, sit down with someone from the SC group and talk to us, because that's sort of a key point that we focus on, is just really how to manage money and the different types of money that's available to individuals. Like you were saying, there's plenty of different fixed and solutions that you can utilize to be able to access money out of those types of accounts, so that you can leave the money inside of your variable accounts, your stocks, your bonds, so that you're not selling at a down market.
Yep. Now, we'll play devil's advocate with selling in a down market. There are certain situations where people have non-retirement money.
Yep.
And now may be an ideal time for them to rebalance to a similar investment. Maybe they're in a growth value fund, and they move to a growth and income or fund or something similar that pays more dividend. But in doing that, they're harvesting maybe a tax loss that could get them more money coming back, next year come their tax time.
Yeah.
And that I think a lot of times people miss out on because they don't think outside the box and see, hey, where can I maybe get that tax write-off? Where can I get that little extra spur so I get an extra $2,000 or $3,000 or whatever that number is, come tax time.
Yeah, absolutely.
Right? What are maybe some other things people want to do with non-retirement money while it's down? Right? They might want to transfer to a trust.
Yeah.
Right? They might want to transfer to something more tax efficient.
Yep.
Right? We run into a lot of portfolios that come to us from other advisors because the other advisors aren't giving them full advice. Yeah. And our goal is to eventually structure them into a tax efficient portfolio.
Yeah.
Well, these down markets might be a good time to heavily move to a tax efficient portfolio. So as the market rebounds, they don't have to worry about doing it again later when they're paying tax on the investment.
Yeah, absolutely. Capital gains tax for a lot of individuals can be hopefully avoided if you structure things the right way. Like you were saying with the certain portfolios that we use, there are a couple of companies that we utilize that allow you to hopefully be able to avoid those capital gains while still making a rate of return for yourself.
Yeah, and it's also worth looking in a down market to maybe accelerate or do your Roth conversion.
Yep.
Now while the market's down, right? Because if your money's in your IRA and it rebounds, you're going to pay tax on all that rebound.
Yep.
But if while it's down, you can move it to the Roth, you get that same rebound, assuming we're talking the same investment, in the Roth, but now all that rebound is tax-free.
Tax-free, yep.
Right? And people have to understand, right? If the market goes down 20%, it has to come back 25 to get back to where it was.
Yeah.
If the market goes down 50%, it has to go back up 100% to get back to where it was.
Yeah.
Well, that 100% or that 25% return, you want to make sure that you're thinking in a down market, how can I maximize that?
Yeah, absolutely.
Right? Can I defer it? Can I get it tax-free? Can I get it into a vehicle that's going to benefit me down the road? Right? Maybe that rebound is going to go in a Roth tax-free, and then eventually you're harvesting in a tax-free vehicle.
Yeah.
Right? So those are all things in a down market that I think would put a client in a much better situation.
Yeah, absolutely.
And you can take a negative and turn it into a positive by rebalancing and relooking at the plan.
Sure. Yeah.
I know we've done that with a lot of clients. Other things we've done with some clients is just rebalancing in their IRAs to maybe a more cost-effective platform, where maybe there's lower expense fees, lower charges, things along that lines, because that'll also help on the rebound.
Yeah, absolutely.
Right, and you don't have to worry about capital gains in those accounts. You don't have to worry about taxes because it's staying in the deferred investment. So there's a plethora of options in there. What would you say is kind of the common thing that you hear from clients in a down market? Like what fear or what things do you get? Because I know I get a lot of different ones.
Should we get out? How much longer until we should sell? Is it going to go down further? It's just, to me, I've always been under sort of I think Warren Buffett said at one time, be fearful when others are greedy and greedy when others are fearful. So ultimately meaning what most individuals do is they flip-flop those. When they see the market going up again, approaching all-time highs, they feel more confident in putting money into the market, as opposed to when it's going down, like we were saying, should I sell? How much lower is it going to go? I'm nervous. They sort of do the opposite of what they should do, which is really where the value of an advisor comes into play, is having the person to help you, like you were saying a few episodes back, doing that emotional side of things to be able to walk them through. But I get people saying, should we sell? Should we put money in cash? What should we do in the future?
Yeah. Well, yeah, I was fascinated at Buffett because he takes simple things and make them sound sophisticated, where all he's saying in that statement is buy low, sell high.
Exactly.
I mean, everybody knows that common sense thing, but he makes it sound so good. He makes it sound so educated, right? But it's
revolutionary.
It's buy low, sell high is basically that entire concept there. But I get a lot of times, this fear of, will it come back and is it going to last the rest of our life?
Yeah.
Right. And one of the things that I do, at least, is I point out to a client, one, how much in their portfolios are in cash positions. Because chances are, if you're with us, if you're with an advisor that has a diversified portfolio, there's money in cash.
Yeah.
Right. And I always like to point that number out because sometimes it's 20 grand, 30 grand, 40 grand or more, depending on the value of their whole asset base, that they're not seeing from the advisor standpoint is sitting there in cash for opportunity or for money if they needed it.
Yeah, absolutely.
So sometimes I'll go into a client and I'll say, hey, look, this is what you have in cash, $35,000. Do you see any expenses coming up that's going to be $35,000? Chances are they say, no, we don't plan on spending any of it.
Yeah.
Well, okay, well, they have to go through $35,000 before we entertain selling something when it's low.
Yeah.
Right? Or maybe I point out the bonds in the portfolio and what their dividend is to show like, hey, even in a down market, this is the income we can generate for you.
Yeah, absolutely.
Right? Off of that, right? So knowing your portfolio, knowing your investments is very important. And I think a good advisor, when a client calls and starts questioning, will point those things out to create confidence that, hey, that short-term bucket is there for me.
Yeah.
Right. And I know you do it. We do it as a team. Is we do a bucket strategy.
Yep. Absolutely.
And there's always a portion of your investment that's short term. And with that brings security.
Yep.
Right. But the fact that we have buckets that are intermediate term and long term, those are the ones that are fluctuating a lot.
Yeah.
Right. But clients confuse that because they look at their assets at a whole, like one big egg. Right. And they say, oh my gosh, everything's going down. But they don't realize that maybe that short-term bucket didn't go down at all or went down 1%. Right. But they're seeing the long-term bucket go down 30%.
Yeah.
And they're, the world's going to end. Right. So, right. You don't want to be a lemming. You want to be following everybody jumping off the cliff at this point, which is important. So, I think hopefully clients take a little bit back from this episode and realize the opportunity that comes with a down market, because that's really ultimately what it is. It's either a buying opportunity, it's a rebalancing opportunity, it's a tax harvest, a tax loss harvesting opportunity.
Yep.
It's maybe a restructuring of income, for you, and maybe it's also wealth transfer.
Yeah.
Maybe it's looking at maybe doing that gift to a client, to a grandkid's account that may be a little bit more aggressive, doing it now versus later on.
Yeah.
Right, and getting it into that 529 or getting it into that UTMA or whatever it might be,
might
make sense, right? To go from their fixed source to something that's down 30%.
Yeah, absolutely.
Which is the main thing. So hopefully there's some questions generated by this. And please, we brought this topic up because we got a lot of feedback from clients that they wanted us to talk a little bit about managing it in a down market and some options to do and stuff like that. As always, you can send those requests to the Esli group. You can just go on yourtimeyourmoney.net. It'll direct you to our team page. You can touch contact there and type in any questions that you have. Another thing that we want to bring up in this segment as we close it out is we're excited for the launch of Perspective Magazine. So this is actually a new illustration that we're going to be doing every quarter out to clients. And it has a wide array of different topics, everything from what's currently going on in the market. We threw in some other things in here that we thought would be fun for clients.
Great.
Some recipes in here and stuff like that. But ultimately, we wanted to provide another resource to clients, and these are going to be quarterly, so with the seasons, and hopefully some really insight and education on the market and what's going on in the economy today. So,
yeah, absolutely.
As always, you can find us at yourtimeyourmoney.net, the Esli Group at 43 British American Boulevard in Latham, 800-222-3202. And as always, we want you to like and subscribe. And if you go into this bottom corner over here, you'll see our subscribe button. So click that button, subscribe, like, forward it down on your social media platforms so that we get more people to hear some good content and some ideas. And we thank you as always. It's your time.
Your money.